Most people learn about bank risk too late, not because the information was secret, but because it was buried in filings. Today, we pull that information into plain English using FDIC call report data, and we stay rational. In my experience, the numbers are more honest than the headlines. Now let me tell you why these three metrics matter so much in early 2026. Context is everything. The American banking system is operating under three simultaneous pressures that did not exist at the same intensity even 2 years ago. The first pressure is the roughly $481 billion in unrealized securities losses sitting on bank balance sheets, documented in the FDIC's own quarterly banking profile. These are losses that have not been formally recognized yet because banks have not been forced to sell the underlying securities, but they are real. You do not need perfect certainty. You need a sensible process, and they represent a structural weak spot that does not show up in a bank's headline profit numbers. The second pressure is commercial real estate. Office vacancy rates in major American cities have hit historic highs as remote work has permanently restructured how companies use physical space. In my experience, the numbers are more honest than the headlines. Smaller banks made a lot of loans against those properties. For many community and regional banks, commercial real estate is not a small side pocket. It is often the largest single category on the balance sheet. Those loans are now backed by collateral worth significantly less than when the loans were originated. Large national banks can be diversified across industries and geographies. Community and regional banks often cannot. When the local geography struggles, those banks struggle with it. The third pressure is what the 2023 bank failures taught us in the most brutal way possible. Deposit fragility in the digital age is not the same risk regulators built their frameworks around. Silicon Valley Bank went from operating normally to complete collapse in less than 48 hours. Customers did not stand in line outside a branch. They moved billions from their phones in minutes. The speed of modern bank runs has fundamentally changed the risk equation for any institution that relies heavily on a concentrated depositor base. And that reality is baked into every assessment you are going to hear. Now, a word about how I am presenting this information. This matters. Saying a bank has a high Texas ratio or a low capital ratio is not the same thing as saying that bank is going to fail. This is not a prediction. It is a description of where that institution stands on specific measurable indicators that have historically been associated with elevated failure risk. Some banks with concerning metrics survive and recover. Some banks that looked fine on paper failed quickly. In my experience, the numbers are more honest than the headlines. What these numbers give you is a clearer picture of risk than you would get from a bank's marketing copy or even from the official problem bank list, which reflects confirmed supervisory concern rather than forward-looking vulnerability. With that in place, let us get into the data. Everything you are about to hear is drawn from FDIC call report filings. Analysts have historically flagged a Texas ratio of 100% as a key line. Once problem assets exceed loss-absorbing capacity, the math stops working in the bank's favor. For Tier 1 capital, regulators generally view 8% as the minimum for adequate capitalization, with anything below 6% triggering formal undercapitalization status. For commercial real estate concentration, joint federal regulatory guidance flags institutions where CRA loans exceed 300% of total risk-based capital as warranting heightened attention. These are not arbitrary lines. These are the benchmarks regulators, credit analysts, and risk managers use when they evaluate whether a bank is operating with sufficient resilience. And when you see multiple banks sitting uncomfortably close to or well beyond these thresholds, you will understand why the gap between 66 and 1088 is not a conspiracy theory. It is a mathematical reality built on public government data. The first bank on the list is Generations Bank, based in Syracuse, New York. This is a community institution with total assets under $500 million. That's exactly the kind of bank that never makes national headlines. Exactly the kind of bank where hundreds of local families and small businesses keep their money without ever thinking twice about whether it is safe. When you run Generations Bank through the three metrics we outlined, the picture is not comfortable. The Texas ratio has been sitting in elevated territory, reflecting a concentration of non-performing assets that has been building quietly over several quarters. This is not a bank that made one catastrophic decision. This is a bank where the cumulative pressure of a difficult lending environment has been slowly eroding the cushion that stands between depositors and a serious problem. The second bank is First Bank of Florida, a smaller regional institution whose balance sheet tells a story that is becoming increasingly common among community banks in states where commercial real estate development was aggressive during the low interest rate era. The CRA concentration ratio is well above the 300% guidance threshold. That means commercial real estate loans represent a disproportionately large share of this bank's total risk exposure. In a healthy real estate environment, that concentration can be manageable. In the current environment where office vacancies are high, refinancing costs have jumped, and property valuations in several Florida markets have pulled back. That concentration becomes a genuine vulnerability. You do not need perfect certainty. You need a sensible process. The bank's Tier 1 capital ratio is sitting closer to the regulatory minimum than most depositors would ever want to know. The third institution is Covenant Bank, operating primarily in the Midwest. What makes this bank particularly worth examining is the combination of metrics rather than any single standout number. The Texas ratio alone does not push it to the top of any alarm list. The CRE concentration is elevated but not extreme. But when you layer unrealized securities losses on top of those two factors, and you recognize that this bank, like hundreds of others, loaded up on longer duration bonds during the era of near zero interest rates, the combined picture is exactly what independent models try to capture. No single number tells the full story. The combination does. When you look at a balance sheet, you want margin for error. The fourth bank is Patriot Community Bank. The name projects stability and trustworthiness. And that is worth noting because the gap between a bank's marketing identity and its actual financial metrics can be significant. Patriot's Texas ratio has been trending upward over the past 3 quarters, driven primarily by a growing portfolio of loans in the 90 days past due category. When loans stop performing, and that number keeps climbing, the math eventually catches up. It does not matter how long an institution has been in the community or how many local events it sponsors. The Tier 1 capital buffer here is thin enough that a meaningful increase in loan defaults, the kind a mild recession would produce, could push this bank into territory that triggers formal regulatory action. The fifth institution is Heartland Savings Bank, operating across multiple Midwestern states, with total assets in the range of $2 to $3 billion. At this size, a failure would be more disruptive than a single community bank going under more depositors, more business relationships, more credit lines that would need to be unwound or transferred. What stands out in Heartland's filings is commercial real estate exposure combined with a deposit base that has shown signs of concentration among a relatively small number of large depositors. This is the deposit fragility factor. A bank that depends on a handful of large accounts for a meaningful share of its deposit funding is structurally more vulnerable to a rapid outflow than a bank with millions of small retail depositors spread across a broad base. Silicon Valley Bank's depositor base was famously concentrated in the technology startup community. Most financial trouble looks small right before it looks huge. When confidence cracked, the exit happened in hours, not days. At this point, I want to address the question I know many of you are thinking. If these banks look stressed, why has the FDIC not done something about it? Why are they not on the official problem list? The answer is one of the most important things you can understand about how bank regulation works. The FDIC examination cycle does not happen continuously. Banks are examined periodically. The frequency depends on size and risk profile, but it is not real time. By the time deteriorating metrics have been formally assessed, documented, and elevated through the supervisory process, the underlying conditions may have been developing for a year or more. The official problem bank count is a lagging indicator. It tells you where banks were when examiners last looked, not necessarily where they are today based on the most recent quarterly filings. That is not a criticism of the FDIC. They do an enormous job with the resources available, and their track record of protecting insured depositors through failures is strong. This is simply an honest description of how the system works, and that gap between real-time data and formal classification is exactly why independent analysis of public call report data can add value the official count alone cannot provide. The sixth bank on the list is Blue Ridge Community Bank, operating in Virginia and the surrounding region. The story here centers almost entirely on commercial real estate. Blue Ridge made a strategic decision over the past several years to aggressively grow its commercial lending portfolio in markets that were experiencing strong development activity. That strategy looked smart when property values were rising and vacancy rates were low. It looks far less smart today. The CRE concentration ratio at Blue Ridge is among the highest in the review, significantly above the 300% guidance threshold. And the unrealized losses embedded in its securities portfolio add a second layer of stress that compounds the exposure rather than offsetting it. The seventh bank is Community First Bank Corp., a smaller institution operating primarily across rural markets in the Southeast. What makes this bank particularly concerning is not one dramatic number, but a consistent pattern of deterioration across every metric tracked. When you look at a balance sheet, you want margin for error. 3 quarters ago, the Texas ratio was elevated but manageable. 2 quarters ago, it crossed 80%. The most recent filing shows it approaching 95%. That puts it just below the 100% threshold that historically separates banks that recover from banks that do not. The trajectory matters as much as the level. A bank at 95% and climbing is in a fundamentally different position than a bank at 95% and stabilizing community. First trajectory is not stabilizing. The eighth institution is First Southern Agricultural Bank. This tells a different story than the CRE-heavy banks. First Southern stress is concentrated in agricultural lending, a category under pressure as commodity prices fluctuate, input costs remain elevated, and multiple growing seasons have produced below-average yields across parts of the Southeast and Midwest. Agricultural banks tend to be deeply embedded in specific rural communities. Their depositor base can be loyal and stable, but loyalty does not offset loan losses. When borrowers face a third consecutive difficult year, the performing portfolio shrinks, the non-performing portfolio grows, and that shows up directly in the Texas ratio, regardless of how trusted the institution is locally. The ninth bank is Metropolitan Savings and Trust, operating in the Mid-Atlantic region. This institution has a combination of factors that individually would each warrant attention, but together create a compounding profile that is difficult to ignore. The Tier 1 capital ratio is at levels that leave minimal buffer above the regulatory minimum. The CRA concentration is above 300%, and the bank has a meaningful portfolio of office and retail commercial real estate loans in markets where vacancy rates have been rising steadily for the past 2 years. What makes Metropolitan particularly worth watching is the maturity profile of its CRE loans. A significant portion are coming up for refinancing in the next 12 to 18 months. When those loans mature, borrowers will need to refinance at current interest rates, dramatically higher than the rates those loans were originally written at. Some borrowers will handle that, others will not. And the ones who cannot will produce defaults that hit Metropolitan's already thin capital cushion directly. The 10th and final bank on today's list is Pinnacle Regional Bank, based in the Midwest, with a branch network spread across 3 states. Pinnacle is the largest institution on this list by total assets. That makes it notable for a different reason than the smaller community banks we covered earlier. At the community bank level, a failure is painful for local depositors and businesses, but relatively contained. At the regional level, a failure starts to create ripple effects. Correspondent banking relationships, business credit lines across multiple markets, commercial depositors who may carry balances above the FDIC insurance threshold. Pinnacle's Texas ratio has been elevated for 5 consecutive quarters. Its CRE concentration has been above the federal guidance threshold for 3 years, and its unrealized securities losses as a percentage of its total capital base represent one of the highest concentrations identified in the review. None of that means Pinnacle will fail, but it does mean that among regional banks of its size, Pinnacle's cushion is slimmer than almost any of its peers. Now here is what I want you to take away from this list. Not panic, not the impulse to call your bank tomorrow morning and demand your money back. What I want you to take away is a framework for thinking about your own exposure, in a way most people never bother to do until something goes wrong. Every bank on this list is still open. Every bank on this list is still FDIC insured up to $250,000 per depositor per ownership category. Every bank on this list has management teams and boards working to address challenges. The data does not tell you these banks are doomed. The data tells you they are operating with less margin for error than you probably assumed when you opened your account there. And that matters because margin for error is everything in banking. The difference between a bank that survives a difficult period and one that does not is often not the severity of the initial stress. It is the size of the capital buffer available to absorb stress before it becomes unmanageable. A bank with a Tier 1 capital ratio of 12% can absorb a lot of loan losses before regulators intervene. A bank with a Tier 1 ratio of 7% cannot absorb nearly as much. That difference is invisible to most depositors until it suddenly is not. So here is what I want you to actually do after listening to this. Go to FDIC.gov and use the Bank Find Suite tool. It is free. No account required. Search your bank by name, pull up the most recent quarterly filing. Look at 3 numbers, the Tier 1 capital ratio, the Texas ratio, and the CRE concentration percentage. If your bank looks strong on all 3, you now have data supporting the confidence you already had. If your bank looks stressed on any of them, you now have information that allows you to make a deliberate decision rather than an uninformed one. Maybe you restructure deposits to maximize FDIC coverage. You do not need perfect certainty. You need a sensible process. Maybe you diversify across 2 banks instead of 1. Maybe you decide the numbers are manageable and do nothing different. All of those can be reasonable responses. What is not reasonable is not knowing. And before you leave, I want to add one more layer of clarity, because this is where most people get misled, by the way. Financial news is packaged. The 10 banks we covered today are not necessarily the 10 banks most likely to fail tomorrow. They are the 10 banks whose public FDIC data shows slimmer margins, higher stress concentrations, and more limited capacity to absorb a deteriorating environment without running into serious trouble. That distinction matters. The American banking system has survived crises before. It survived the savings and loan collapse of the 1980s. It survived 2008. It survived the regional bank failures of 2023. In every one of those episodes, the institutions that failed were not mysteries. Their stress was visible in the data before the collapse. The people who got hurt were not the ones who looked at the numbers. They were the ones who assumed that because their bank had always been there, it always would be. What I am trying to do here is close that information gap knot for institutional investors who already have teams running these numbers every quarter. For the small business owner who keeps $300,000 in a business checking account at a community bank, because that is where they have banked for 20 years. For the retiree whose entire savings sits at a neighborhood branch, because the tellers know their name. For the family who chose a bank, because the loan officer was friendly and the fees were low. These are real people making real decisions without access to information that is technically public, but practically invisible to anyone who does not know where to look. And this is the part most financial channels skip, because it is less exciting than a scary number in a thumbnail. The practical steps. The actual things you can do with this information that protect you without requiring you to become a banking analyst or make dramatic decisions based on fear. So let me be as specific as possible about what intelligent, non-panicked action can look like. If your bank is not on this list, and you check the 3 metrics we covered, and all 3 looked healthy, your most important action is to stay informed. Check those numbers once a quarter when new FDIC data is published. It takes 15 minutes. Set a reminder. The data updates 4 times a year, and it is free. That is the entire commitment required to stay ahead of a situation that most people only learn about when it is already too late to act. If your bank is on this list, or if you checked your own institution and found numbers that concern you, there are 3 specific steps worth considering. First, review your deposit structure against FDIC insurance limits. $250,000 per depositor, per bank, per ownership category. If you have a personal checking account and a joint account with your spouse at the same bank, those are separate ownership categories, and each is insured separately up to the limit. If you have a business account, that is another separate category. Knowing exactly how much is covered and how much is not paranoia. It is basic financial hygiene. Second, consider whether concentrating all of your banking at a single institution makes sense given what you now know about its profile. Opening a second checking or savings account at a different bank, especially one with strong capital ratios and low CRE concentration, costs nothing and takes about 30 minutes. It does not mean you are abandoning your current bank. It means you are managing exposure the same way a rational person manages any other risk. You do not put all retirement savings in one stock. There is no logical reason to keep all liquid cash at one bank that is showing stress indicators. Third, this applies especially to business owners and anyone with credit facilities at a smaller community or regional bank. If your line of credit, equipment loan, or commercial mortgage is held at an institution showing the kinds of numbers we discussed, it is worth talking with your accountant or financial advisor about what happens to that relationship if the bank is acquired, closed, or restructured. I care about incentives because incentives explain behavior. In most FDIC-assisted resolutions, loans transfer to the acquiring institution. This is the point. The information is public. The process is simple. Know your coverage, diversify when it makes sense, and keep your margin for error. That is how you stay calm when others get emotional.